Welcome to The Explainer. Today we're diving deep into a name you've definitely heard a lot about lately, the pharmaceutical giant Pfizer. And we're here to tackle a pretty massive question, especially if you're an investor. You've got this $140 billion behemoth, but is it possible its stock is actually undervalued? A bargain hiding in plain sight? So here's how we're going to tackle this. We'll start with a quick look at the company itself, then we'll dive into the key financial numbers. After that, we get to the fun part, the valuation puzzle. We'll actually calculate its intrinsic value and finally reach a verdict. All right, let's get into it. All right, first things first, we need to get a good handle on exactly what we're looking at. Who is Pfizer? And maybe more importantly, who's really calling the shots? So this gives us that bird's eye view, the basics like their New York headquarters and their stock ticker, PFE. All that's important, but what we really want to dig into is what kind of business they're in and who actually owns the company. Okay, so Pfizer sits right in the middle of the giant healthcare sector, and more specifically, they're in the drug manufacturer's general industry. Now, what that tells you is these guys are not a one-trick pony. They're a broad-based pharma company with a really diverse portfolio. Think everything from vaccines to cancer treatments. They're not just some niche player. So who's behind the wheel here? Well, almost 68% of Pfizer is owned by huge institutions. We're talking about the Vanguards and Fidelities of the world. Now, that's pretty standard for a big blue-chip company like this, and it tells you that a lot of smart money is betting on its stability. And that $5.68 billion public float, that's all the shares you and I can trade. So the big question is, does that perceived stability actually show up in the numbers? Let's find out. Okay, so we've got a handle on who Pfizer is, but now let's talk numbers. What's the real story behind their financial health and performance? This is where it gets really interesting. First up, let's just appreciate the sheer scale we're dealing with, a market cap of over $140 billion. I mean, that's the total value the stock market puts on the entire company. It puts them squarely in the mega cap club. And a valuation that big doesn't come from nowhere. It's built on a foundation of absolutely massive revenue. We're talking almost $64 billion. And that's not just a number on a page, right? That represents the incredible scale of their operations all over the world. Okay, these ratios here, they're like little shortcuts to help us figure out if the stock price is, expensive or cheap compared to how the company's actually doing. So take the PE ratio, price to earnings. It's sitting around 13 based on what they've already earned. But here's the kicker. Look at the forward PE. It drops all the way down to under 8. That huge dip is basically Wall Street analysts saying, hey, we think their earnings are about to grow a lot. And wow, this chart really drives home just how profitable they are. A gross margin of almost 74%. Just think about that. For every dollar of medicine they sell, they get to keep nearly 74 cents before other expenses. That's pretty impressive. Okay, so the top line numbers look solid. But how do we get from solid numbers to what the stock is truly worth? And that question brings us to the real heart of this whole analysis. We need to figure out what Pfizer is actually worth, completely separate from the wild, up and down noise of the daily stock market. The magic word here is intrinsic value. The easiest way to think about it is, what's the company's true value? The value based on nothing but its ability to generate cold, hard cash, now and into the future. So how do we calculate that? Well, one of the gold standards for this is a method called discounted cash flow, or DCF. It's honestly a bit like a time machine for finance. You're basically taking all the money a company is expected to make in the future and calculating what that pile of cash is worth right now in today's dollars. All right. Theory's over. Let's roll up our sleeves and actually apply this DCF model to Pfizer using a very specific set of assumptions. Now, any model like this is only as good as its inputs, its assumptions. So here are the key ones we're using. Take a look at the beta, 0.465. Since beta is all about volatility, a number under 1 like this tells us Pfizer's stock tends to be less choppy than the market as a whole. And then there's the WACC, the weighted average cost of capital. That's just a fancy way of saying the average return the company has to pay out to all its investors to keep them happy. So we plug all that into our financial time machine, and what do we get? Well, we get a range of possibilities. If we're pessimistic, the worst case with slower growth, the model spits out a value around $55 a share. But if we're feeling optimistic, the best case, it could be worth as much as $72. But for our analysis today, let's stick to the middle ground, the most likely or base case scenario. And in that case, our model points to an intrinsic value of right around $63 a share. Okay, here we go, the moment of truth. We have our calculated true value of $63. How does that compare to what people are actually paying for the stock on the market right now? And, well, this is pretty much the whole story right here. Our deep dive analysis suggests the stock should be worth $63. But if you look at the market price, it's trading for less than $25. That is not a small difference. That's a massive gap. So, what's the bottom line? Based on this specific model, with these specific assumptions, the conclusion is pretty straightforward. The stock looks like it's seriously undervalued. So we've got this data-driven conclusion, but it leaves us with one last really big question, doesn't it? Why? Why does this huge gap exist? Maybe the market is spooked about something. Patents running out or growth slowing down post-pandemic. The numbers we ran are screaming value. But figuring out why the market disagrees, well, that's the real homework for any potential investor.